Friends, welcome to you all around the world. Welcome to the Follow the Money podcast. My name is Jerry Robinson. I'm your host. I'm the author of the book Bankruptcy of Our Nation, the founder here at followthemoney.com, a website dedicated to helping people just like you learn how to trade, how to invest, how to generate more income, just basically how to better your financial world. And that's really what our website is all about. You can always check us out online, followthemoney.com. Now, today we have a very good show lined up for you. It's episode number 461. The title is Stock Trading Basics. And as you can imagine, this episode is going to be focused upon the fundamentals of trading, right? So whether you're new to the trading world or you're looking to brush up your skills, this episode is packed with insights to help you navigate the complexities of stock and ETF trading. And we're going to answer many of the questions that we have received over the years. In fact, these are just perennial questions. We receive them regularly from new traders. And this, by the way, this show is really focused upon new traders. You know, in this episode, I want to answer some of the most common questions we get from new traders about how to get started in trading the markets. And if you've been trading for a while, you can consider this episode as a good review of basic principles and ideas. But for those who are new to trading, I think this episode will be very helpful. So without further ado, let's get started. So let's dive into today's show. We've got a great episode lined out for you today. And as I mentioned, we're going to be tackling these frequently asked questions. We're going to have time for about 7 of these frequently asked questions that come in from new traders all the time here at followthemoney.com. And we're going to begin with question number 1. Question number 1, what is the difference between stocks and ETFs, and which one is better for beginners? This is a great question. And many people, especially beginners, are not familiar with ETFs. They have heard of stocks, of course. They maybe have heard of cryptos, but ETFs, they may not know what that means. And of course, if you're across the pond, if you're one of our European friends out there, you may be more familiar with things like CFDs. And those are known as contracts for difference. But we're going to focus upon ETFs in this particular episode. And we're focused upon the difference now between stocks and ETFs. Well, first off, let's define these terms clearly. You have a stock, and that is a type of security that signifies ownership in a corporation. So basically, you're an owner of a company when you own a share of stock, and that represents a claim on part of the corporation's assets and earnings. And when you buy a stock, you're buying a piece of that company. That's pretty empowering for new investors to know about, and new traders especially. Now, depending on the type of stock, you may receive dividends, and you obviously have the potential for capital appreciation, which means the value of your stock can go up. And that's where trading comes in. You know, you're looking for that capital appreciation, not necessarily the dividend. However, it also means that you're subject to the risks of that single company. So when you buy a company, even if it's just to trade that particular company or stock, you're really dependent upon the financial health of that company, the market position, the sector trends. These can all greatly affect the price of the stock. On the other hand, now you have the ETF, which is an acronym or a short for Exchange Traded Fund. And this is a type of fund that owns underlying assets, usually stocks, but sometimes bonds or futures or gold bars or foreign currency. And it divides ownership of those assets into shares. And these shares are what you buy when you buy an ETF. Now, the key difference here between stocks and ETFs, aside from how they're put together and some of the different moving parts, is really, for the trader's purpose, diversification. Because ETFs typically hold a broad portfolio of stocks. Not always. Not all ETFs are set up that way, but when we think of index ETFs, for example, that track a particular index, you're dealing with a broad portfolio of stocks there across various industries. Sometimes they're focused upon specific sectors or strategies, but when they own many stocks, that offers some built-in diversification, and that helps reduce the risk that you're involved with whenever you buy, an ETF as opposed to a stock. Now, let's get to the crux of the matter of this question. The question is, which one of these is better for a beginner? Well, I've been coaching traders now for over 15 years. It's hard to believe. And when I think about newcomers to the investment world, I just automatically gravitate towards ETFs. And that's because I find that they provide a safer entry point than individual stocks. And the reason is because they offer immediate diversification with just one transaction. And that's crucial because diversification can really help mitigate the risk that you will have as a new trader. So if one asset within the ETF underperforms, well, then the performance of the others can help offset that impact. Also, ETFs are generally less volatile than individual stocks. Now, that may turn off some traders who are looking for, excessive amounts of volatility. And so that's one thing to keep in mind. But the trade-off for that is that you have less of that single stock risk, right? ETFs are also usually more cost-effective. And so when you buy one ETF share, it allows, your investment to go across a range of stocks at a lower cost than purchasing each stock individually. So, and many ETFs, track well-known market indexes, which I think is probably the very best way for a new trader to begin. My personal trading niche is the NASDAQ 100, which you can get access to in a single ticker, 100 different top non-financial, mostly tech-heavy stocks in the NASDAQ 100. To me, that's one of the very best types of indices that you can look at. You can also look at the S&P 500. All of these have their own ETFs. And so this can really make a big difference instead of taking a single stock where you do have a bit more risk, So when I look at ETFs and stocks for new traders, I think of ETFs as providing ease and reduced risk. They may not offer the same potential for the higher returns that you may get from carefully selecting an individual stock at the right time. But if you're someone who enjoys research and you're willing to take on those higher risks for potentially higher returns, well, you may want to start with stocks. They may be more appealing to you. But for most beginners, the lower risk, the ease of management, the immediate diversification that is offered by ETFs, I think, makes them an ideal starting point in the journey of trading. So great question. Which one should we look at, stocks or ETFs when we're new? Which one's better? I got to say the answer for me is ETFs, especially index types of ETFs that give you broad diversification. It just takes away that single stock risk. Okay, so let's dive into another very practical question on today's broadcast that many aspiring traders will ask, and that is, how do I get started in trading stocks or ETFs? What are the first steps? This is a great question. Many people want to get started. They have heard about trading. They want to, make their first trade, but they're like, where do I start? Well, when you start your journey in the world of stock and ETF trading, it's exciting, obviously, and you want to be careful not to get caught up in the excitement. It's essential to approach trading with a clear plan and solid understanding. And so the first step, in my mind, is that you need to educate yourself about the financial markets. You need to educate yourself about the different instruments that are available to you as a trader. And you want to also understand the basics of how stocks and ETFs and indices and how all these work, and also understanding the economic factors that influence market movements. That's crucial. You can find tons of resources online for this. There's courses, there's books, there's webinars, there's articles. We have many right here on our website. We have lots of trading courses on our website. Go to followthemoney.com/shop. There you'll find all the different courses we have. We actually have many more for our members. Our own website offers a wealth of educational materials that can help you get started. Now, once you feel comfortable with the basics, once you've got some education, and it's not going to be overnight. You're going to have to spend some time kind of learning, just like you learn how to ride a bike or you learn how to do some skill. Don't short change yourself on this. you really want to give yourself opportunity to really learn. But once you feel comfortable with the basics, well, the next step is to choose a brokerage firm. So you look for a reputable broker that aligns with your trading goals and offers, an easy to use platform. You're looking for zero transaction fees. It used to cost money to trade. You used to have to pay $5 or $10 to make a trade, both ways, buying and selling. Today, most of the major platforms don't charge a fee anymore, and that's fantastic. You also want to look for good customer support. There are several online brokers available that cater to beginners. They offer tools and resources to help you make informed decisions. Some of the more popular choices include things like Fidelity, E-Trade, Robinhood, many of these different ones that many people are familiar with that are known for their user-friendly interfaces and comprehensive educational resources. I've used E-Trade for a long time. I'm very happy with them. Interactive Brokers is another one that's very good. Fidelity and Schwab, both of these have great platforms. So it's really kind of your own preference. But after you select a broker, then you're going to need to set up a trading account. And that process typically involves providing some personal information. You're going to have to give some information to the brokerage firm. You got to complete a financial questionnaire to assess your investment experience and your risk tolerance. The firm wants to know basically, how have you traded before? Do you have any experience? And then you're also going to need to decide between different types of accounts, whether you're going to use like a standard brokerage account, which is just basically funded, with cash, or are you going to use a retirement account like an IRA? Now, I really like the idea of trading within a retirement account or an IRA because you don't have any taxable event. Typically, you won't have a taxable event as you buy and sell. And so that, that's one way that I really think, trading, for example, in a Roth IRA can be really advantageous in my opinion. But again, everybody's different. And so you have to figure out, am I going to have just a regular cash brokerage account? And remember, if you have just a regular brokerage account, then every trade is going to be taxable and you're going to have to keep track of that for tax purposes and all of that. The benefit is that you'll be able to have that cash and use it and trade for, current income. Whereas if you don't need the current income, then you can trade within a retirement account and just basically grow your retirement account and use trading for that purpose. That's what I like to do, but everybody's different. Now, next, you're going to have, once you've chosen the account, you need to fund the account. That's the next step. So you got to start with an amount that you're comfortable with and that you can afford to lose. We're going to talk more about how much you might put into your trading account to get started. But for now, just know that you're going to have to fund it. And just know that the money that you put in there, you need to be prepared to lose, especially as a new trader, because, a lot of people lose money. I mean, the majority of traders lose money as they get started. I hate to break it to you, but that's just how it is. It's kind of the tuition that you pay on Wall Street. You learn your way, as you go forward, and you're going to fall down. Just like when you're riding a bike, you're going to fall down a few times, skin your knee. Well, you're going to lose money whenever you're trading as a new trader, and you're going to lose money forever. I mean, all traders lose money no matter how long they've been doing it, and don't let anybody tell you otherwise. That's just how it is, right? The goal is wise risk management, where you learn to lose less than you make, right? That's the key. To let your winners run and then cut your losers short. But anyway, it's wise to begin trading with a small amount of capital, I'll just be honest with you, while you're learning the ropes, rather than investing a huge sum of money right away. I would not do that when I'm a new trader. Now, before you make your first trade, it's also essential that you develop a trading strategy. You want to have a trading plan. This should include your financial goals, how much you're willing to risk you're willing to take, how you'll decide to buy a stock or how you'll decide to sell. What are your rules? Are you looking for what style of trading are you going to do? Day trading, swing trading, position trading. We'll talk about those more in a minute too. Your strategy is basically going to guide your trading decisions, and it'll help you stay focused. It'll help you stay disciplined. And then finally, you want to start trading slowly. You want to begin with small trades, even paper trading, quite frankly. One of the very best ways to get started, in my opinion, is to just trade on paper to see if the strategy works. And you want to see how you want to start getting an idea of how the market moves, kind of getting your finger on the pulse of the market, right? So you want to see how the market responds to economic events. How does it respond to the Fed? How does it respond to specific news? And then, of course, you're going to want to use stop loss orders to limit potential losses, and you're going to want to stay informed about the markets that you're trading in. So you want to remember the key to successful trading is not just in making profitable trades, but also in managing your risks and continually learning and adapting your strategies. So great question there. How do you get started trading stocks? What are the first steps? Those, are many of the steps that you'll want to think about as you're getting started. So that's a great question. Question number 3. We're going to go through 7 questions today. Hope these are helpful for you, especially for those of you who are new. I want to encourage you to, if you've never heard of our Stock Trading University podcast, I encourage you to check that out on our website as well. Just go to followthemoney.com/podcast, and you'll find a slew of stock trading podcasts, episodes that we've done over the years. We have like 90 or so, 80 or 90. It's like you basically learn how to trade in a minute a day. And we have tons of really short form podcast episodes there. So be sure to check that out, followthemoney.com. Click on the podcast button. You'll see the Stock Trading University podcast there. All right. Well, anyway, let's continue on. Question number 3. What are the key indicators that you should look at before buying a stock or an ETF as a new trader? Well, when you're trading, you really want to take a dynamic approach, right? You want to focus on short-term price movements and market trends. And let's talk about some of the essential indicators that you can use to make some good informed trading decisions. First, let's talk about technical indicators. They're very crucial for traders. And if you're not familiar with technical indicators, that's okay. If you're new, that's fine. You will understand that these are tools that you can apply to a chart, and chart reading is vital for new traders. So you're going to want to be comfortable with reading a chart. And you're going to want to be comfortable with applying technical indicators to that chart, things like moving averages and the relative strength index, known as the RSI. Moving averages can help smooth out price data. That's why I like them so much. They create a single flowing line, which makes it easier to identify the direction of the trend. And then the RSI measures the speed and the change of the price movements, and it helps you indicate overbought and oversold conditions, which can signal potential reversal points. Now, it's also very important to focus on volume. Volume is a critical indicator for traders. So high volume often indicates strong interest in a stock or an ETF, and that can often be a precursor to a significant price movement to the upside or to the downside, depending on the type of volume that you're getting. And then you want to analyze those volume patterns alongside the price movements so you can help you confirm trends or maybe even identify a reversal if the price moves one way and the volume moves another. And then there's also volatility, right? This is key for traders. You can use a technical indicator like the Bollinger Bands or the average true range, known as the ATR. That can give you a sense of how much a stock or ETF might move in the short term. And when you understand volatility, it's going to help you set appropriate stop losses, and it'll also help you manage risk in trading. So very, very key to understand volatility. Traders can also consider price patterns and chart formations, such as head and shoulders patterns, flags and triangles, all different kinds of patterns out there that you can pay attention to that can help you indicate or help you identify potential market moves. And then also, lastly, I should include candlestick patterns. These can really provide a lot of insight into market sentiment. We were just teaching our members about using monthly charts and using candlestick patterns, such as dojis or engulfing patterns. That these can provide signals that can be used to forecast reversals or continuations of trends. And so, in conclusion on this question, trading is all about recognizing patterns, understanding market signals, and then reacting quickly to those changes. It's unlike long-term investing where you just kind of buy it and then kind of forget it. Trading focuses heavily on technical analysis, market psychology, chart reading, right? And you got to master some indicators so that you can equip yourself to be able to make quick and informed decisions, which is essential in the fast-paced world of trading. Now, remember, successful trading is not just about the tools that you use, but it's also about how you use them. So you've got to have discipline. You've got to have consistency in your approach. You want to have a well-practiced strategy. These are just as important, if not more, than the indicators themselves. So great question there regarding what are the key indicators to look at before you buy a stock or an ETF. Now, another question that we get a lot, this is probably one of the most common questions, is question number 4. How much money should I start with when trading stocks? Great question. And I mentioned earlier, I kind of hinted that less is more, right? Less is better, I think, especially when you're first getting started. This is a really important question because the amount of money that you start with can significantly influence your trading strategy and the comfort level that you have while you're trading. So first and foremost, I got to stress this. It's crucial to only invest the money that you can afford to lose. Don't trade with rent money, right? Don't trade with grocery money or diaper money. I mean, don't do it. Stay away from taking on excessive risk. The stock market offers great opportunities for wealth creation, but it also comes with the risk of loss, right? Especially in the short term. Short-term traders are more prone to loss perhaps than anybody. And so beginners should start with an amount of money that will not jeopardize their financial stability or their ability to meet essential living expenses, right? So if you're just starting out, I recommend beginning with a smaller amount of capital that you feel comfortable experimenting with. Consider it experimental capital. And I wouldn't even put money at risk until I had paper traded my ideas. And by paper trading, I just mean instead of actually trading the trade idea with your own hard-earned money, instead you just act like you do. Kind of like it's just paper. You put it on paper and say, okay, imagine I bought this stock at this price. Now, you're not going to feel the emotions that you would normally feel when there's real money at stake, but it will help you identify whether your strategy is working or not. And so before you even put any money at risk, I would be paper trading my ideas, paper trading my strategy to make sure that it's working. But when you do put money in, you might start with just a small amount. It all depends upon, it's all relative. I mean, if you're sitting on millions of dollars, well, then maybe you could start with a $25,000 or $50,000 balance, and it wouldn't make a difference to you. But if you're not sitting on a ton of money, well, you might want to start very small, maybe something like $500 or $1,000, and just kind of get your feet wet. Just kind of all depends upon your financial situation. But again, the important thing is not the amount of money that you put in, but make sure that it's not jeopardizing your financial stability. Make sure it's not negating your ability to meet your living expenses, right? And you want to start small. That's always what I've said. Start small. This allows you to learn the mechanics of trading without exposing yourself to significant financial harm. And one of the benefits of starting with a smaller amount that I've found is that I stressed this before, is that you have this ability to test your trading strategy and see how you react to wins and losses. It's very, very important. And your emotional response to trading may surprise you. Many people don't know themselves until they begin to trade, and they find out some things about themselves that maybe they didn't know. So you should also be aware that some brokers, by the way, require a minimum amount to open an account, which may range from a few $100 or maybe even a few $1,000. So you need to know that ahead of time. Consider the costs associated with trading. You're not going to have any commissions, but you will have a spread between the buy and the sell price that is known as slippage. That can eat into profits, especially if you're starting with a small account. So you've got to be careful there. And as you gain more experience and confidence in your abilities, you can gradually increase the amount of money that you commit. This is what I did, and what many of our students have done is they start small, and then as they learn their skill and as they get better and better, they'll put a little more money, at risk. And that's just how it works. This will not only increase potential returns, but it'll also help you practice kind of moving in and scaling into trades as opposed to just going all in and lump sum, trading. Ultimately, the amount you start with should be guided by your own financial goals. Nobody can really answer that question but you. You need to know your financial goals. You need to know your risk tolerance. You need to know what your trading strategy is. And so once you have a clear plan and you have a commitment to ongoing education, well, then, you're set to go. Every trader's journey is unique, though. You got to remember that. There's no one-size-fits-all answer with how much you should start with, but I think the answer is small. You should start small and then just let it grow as your knowledge and strategies, improve. Okay, so that's a great question. Question number 4, how much money should I start with when I'm trading stocks? Now, let's talk about question number 5. We're moving through the 7 frequently asked questions by new traders. I hope you're enjoying this as much as I am. Now, let's move into question number 5. What strategies can new traders use to pick stocks? How do you pick stocks? What strategy would you use? Well, the strategies that you want to use are going to be determined upon how you want to trade, right? So unlike long-term investing, where again, you buy a stock, maybe you dollar cost average into a stock or an ETF just over the long term, and you don't really think about selling, you just kind of long-term investing. Well, trading focuses upon capitalizing on short-term market movements. And so you're kind of going in and then you're getting out. Now, how often do you want to do that? That's going to determine the strategy that you use. So there are several different effective trading strategies that you can use. First up is day trading. It's one of the most well-known trading strategies. This is how I got started. This involves buying and selling stocks within the same trading day. And traders use this strategy to capitalize on price movements during the market hours. Now, day trading is super fast-paced. It can be very stressful. It requires a good grasp of technical analysis, the ability to make quick decisions, and tools for day traders. I mean, the really key tools that they use are real-time charts, a solid trading platform, and access to great technical indicators, right? Which is what you're going to find with every brokerage firm out there. Then you have swing trading. So as we're talking about this, we're kind of moving up the scale now. So you have swing trading. That's another great strategy. That's something that I've been doing for many years as well, especially for those who can't commit to the full-time hours of day trading. Day trading requires you to be sitting in front of the screen most of the day, or as long as you're trading anyway. But swing traders hold stocks for several days to capitalize on some expected upward or downward market shift. And so this strategy relies heavily upon analyzing chart patterns and interpreting market momentum. And it requires a deeper understanding of market sentiment, quite frankly. So swing trading is also a very good place to start. I think it's a fantastic way for people to get started. One thing I didn't mention, there's also a very short-term strategy, even more short-term than day trading, if you can believe it, and it's known as scalping. That's one of the quickest trading strategies out there. It focuses upon very short-term trading. Scalpers aim to make numerous trades that earns very small profits, which add up over time. So scalping is not something I really recommend to new traders, as it's pretty intense, but it is certainly a strategy. There's also position trading. Now, position trading is my own personal favorite strategy, and it's for those who really don't want to sit in front of the computer at all. They will buy a stock, they will set their stop loss, they might let that stop loss be a trailing stop loss, and they will hold that position oftentimes for many weeks and often for many months. This is what I do. I consider myself today a part-time position trader. I got started as a day trader in the 90s, and that was pretty wild. It was during the dot-com bubble, and so I saw a lot of things there. I slowly shifted to options trading and some swing trading, and I've really kind of found my niche in part-time position trading over the years, and it's what I enjoy. So position trading is a lot longer-term approach. And there's many other types of strategies you can use as well. You can focus on momentum trading. That's where you're buying stocks that are showing upward trending prices and selling them when they appear to have peaked. That's similar to position trading and even similar to swing trading. But there's all different kinds of strategies that you can use. I've just laid out a few of them here for you. But it's crucial to understand that the strategy should fit not only the market conditions that are going on at the time, but also your personal trading style and your risk tolerance. So each of these strategies are going to require practice. You're just not going to just immediately know how to do it. It's going to take continuous learning. You're going to want to start with a paper trading account, hone your skills without financial risk. And remember that discipline and money management, strict money management, are the key to success in trading. And then when you master these strategies and then you combine them with effective risk management and a clear understanding of the market, then you're positioning yourself to make informed and timely trades that can really, lead to good profits over time. Great question, number 5 there. about what kind of strategies can new traders use to pick stocks. Now let's talk about question number 6. We're moving through the 7 frequently asked questions for new traders. Question number 6, how can I minimize risks when I am trading stocks or ETFs? This is the question that I think every new trader should be asking themselves. You want to know, how do I not lose money? Well, you're going to lose money, as we've already said. You've got to be prepared for that. Trading inherently involves higher risks than investing, right? Especially when given the short-term nature of the activity. I mean, it's very short-term in nature. And the longer term you can make it, oftentimes the better off you'll be. That's why I really like position trading. Because it gives you more time. And also longer term options trading can be very powerful too for that same reason. But there are some strategies that you can use as a trader that'll help you manage and minimize the risks that you're going to face as a trader. Number one is the importance of setting stop loss orders. I never trade without a stop loss order. Just how it is. It's one of my rules. I just don't place a trade unless I have a stop loss. It's an absolute for me. And it's an absolute for all of my students. Now, they may choose not to do it, but they heard me say that it's an absolute must. So a stop loss order is an automatic order that you can set with your brokerage firm that sells a security when it reaches a certain price, so that it effectively limits your potential loss on a trade. Or it can work the opposite way too. It can kind of trail behind, your stock as it's going up in price, and then it can lock in a gain. So stop losses are great, especially if you're working during the day or you're not going to be sitting in front of the computer all day. You don't want to be looking at your phone or your iPad or your computer or whatever. You just want to be out doing stuff. Well, your stop loss will automatically sell and lock in a gain or prevent a further loss, which is very powerful. So that's crucial because it takes the emotion out of the decision making. You're not sitting there looking at it thinking, should I sell? Should I buy? Well, you set a stop loss, and the stop loss it's like a preset rule that ensures you don't hold on to a losing position too long in hopes that it'll turn around. And believe me, many new traders do that. They'll buy a stock, they'll see it go down, they'll say, oh, I'm going to add more. No, you don't add more. If it's going down, it's going the opposite way that you thought it was going to go. So you don't add more to a losing position, right? So that's very, very important. Stop losses, I cannot stress the importance of them. They're extremely powerful. Another thing that you can do is, to minimize risk when you're trading stocks is the critical strategy is position sizing. Now, that involves controlling the amount of money that you put into any single trade. Now, a common rule that I teach here is that you should risk no more than 1% of your total trading capital on a single trade, 1 to 2%. That helps ensure that no single loss can significantly impact your overall trading capital. So that means, when you set your stop loss, make sure that it doesn't compose, more than 2% max of your total trading capital. I prefer 1%, especially for new traders. You can also utilize risk-reward ratios. That's very pivotal for new traders. Before you enter a trade, consider the potential upside versus the downside. Many successful traders look for a risk-reward ratio that offers a 3-to-1, returns, like a 3-to-1, 3 times the reward to the potential risk, basically is what I'm saying. So this strategy ensures that over time, the profitable trades will outweigh the losses. Also, as I mentioned, you can use technical analysis. That's particularly important for traders. Using chart patterns and technical indicators like that RSI or moving averages, like I had mentioned, and trend lines that can help predict market movements and identify safer entry and exit points. So when you combine several technical tools, it'll help you provide or get a clearer picture, and then also reduce the likelihood of entering risky trades based upon incomplete information. And then also, lastly, the practice of regularly reviewing your trades. Now, this is huge. If you really want to improve your trading and you want to minimize, risks going forward, you really want to keep a trading journal. And this is where you're going to document your trades. You're going to include the strategy that you used. You're going to include the outcome of that trade and any lessons that you learned through that trade. And that reflection is going to help you identify patterns in your trading, both successful and unsuccessful, and it'll help you refine your strategies accordingly. So successful trading involves more than just successful trades. It requires systematic risk management. And if you implement many of these strategies, you're going to help shield your trading capital from excessive losses that many traders are prone to, and it'll help you, improve your overall trading performance. So great question. Question number 6, how can I minimize risks when trading stocks? That's a question that you want to keep at the top of your mind at all times as a new trader. And then finally, question number 7 on today's broadcast. We're going to close out with this frequently asked question when it comes to new traders. What are some common mistakes that new traders make, and how can I avoid them? Oh, that's a good question. That's a great question. So let's wrap up with a crucial topic here that every new trader needs to hear. What are some common mistakes that new traders make, and how can you avoid them? Understanding the pitfalls that face new traders is really important for your success in the stock market. Trading is a skill, right? It's just like I said, riding a bike. It's just like any other skill that you can learn. It's a trade. Trading, I've often talked about the trade of trading. You can learn a new trade, and that is how to trade. And trading requires quick decision-making, right? It requires a deep understanding of market mechanics. It requires disciplined risk management. So let's talk about some of the pitfalls that traders often encounter and how to steer clear of them. One of the most common mistakes I see that traders make is that they trade willy-nilly. They just trade because they get a wild hair and they just want to go to. But what I mean is they're trading without a tested strategy, right? They're trading without a trading plan. So many new traders jump into the market driven by excitement or hearsay, or so-and-so said to buy this stock, or my uncle said this, or my best friend said this, but they don't have any solid back-tested strategy. So it's vital to develop a trading plan that includes specific criteria for when you're going to enter a stock, when you're going to exit that stock, and how you're going to manage the risk while you hold that stock. And then you want to stick to that plan consistently, right? And that takes a lot of the emotion out of it. And for some people, that takes the fun out of it. Because see, for some people, trading is an exciting thing. It's a emotional thing. But can I let you in on a little secret? Especially for those of you who are new traders, good trading is actually boring. And it may seem strange. You say, well, no, trading sounds like it's exciting and, it's something that I'm going to do and I'm going to all this emotion. Well, you certainly are going to feel emotion, but you're going to want to learn to blunt that emotion, because your emotions are not going to help you. They're not going to help you as a trader, right? So trading without a tested strategy, that's a very negative thing that you're going to harm yourself. So you want to have a trading plan, a strategy in place. You want to have entry rules, exit rules, stop loss rules, risk management rules, on and on. And you want to keep those rules to where it's almost something that's automated. It almost begins to feel like robotic, where you're just doing it. And the more robotic you can get with your rules, the more powerful and more successful, quite frankly, your trading will be. The more emotional you are, the more prone you are to make mistakes. So that's a huge thing. Another big pitfall for new traders is overtrading, what I call overtrading, and that's a big significant error. It's easy to get caught up in the action, especially in volatile markets. But when you make too many trades, it can really cause a lot of what I call decision fatigue. And so you want to be careful. Many traders feel like if I'm not trading all the time, well, then I'm not really doing what I'm supposed to. That's not true. What I often consider good trading is waiting for the setup to come to you. So if you're trying to force a setup, then you're probably going to be making mistakes. But if you sit back and create your rules and wait for the opportunities to come to you, well, you're going to find that you'll be able to avoid this pitfall of overtrading. So careful trade selection based upon your strategy criteria is going to protect you from this pitfall. Let me stress again the importance of the stop loss. Let me just say that another critical error that I see, or pitfall that I see new traders fall into, is that they ignore the stop loss order. They just ignore it. Stop loss orders are designed to limit an investor's or a trader's loss on a position in a security. And if you don't set stop loss orders, then you're exposing yourself to potentially you're definitely exposing yourself to big losses, right? And so always determine your exit point before entering a trade, and then set that stop loss order accordingly. If you do that, you're going to be ahead of most other new traders. Let me tell you, there's a few more we can talk about here when it comes to pitfalls. Believe me, I got a big list when it comes to pitfalls for new traders. Failing to manage your emotions. We've already hinted at some of these, but let's just reiterate them. Failing to manage emotions. That can devastate your trading. capital. It can devastate your future trading career, quite frankly. Trading can be stressful, and it can cause emotional highs. It can cause emotional lows. That, of course, will lead to poor decision making. And traders need to practice emotional discipline. They need to develop and maintain a calm demeanor. And these are crucial skills that every trader needs to develop. So this might include, again, setting rules for when to stop trading after a loss so that you avoid revenge trading, which I've seen many times in new traders where they'll lose money on a trade and then they'll feel bad about it. So I'm going to go back and I'm going to get my money back. And so they'll go and they'll trade it again and then lose money again, right? Oh, and then it really gets emotional. Oh, goodness. And then the same thing can happen on overconfidence. I often tell a story. I don't have time to talk about it today on today's show, but I've probably told it on many shows before, or many podcast episodes before, where, sometimes a big win, you have a really good day in the trading market, you feel invincible, and of course, emotion is attached to that. And then you go out and then you lose the money you just made on a dumb trade because you were overconfident. So again, you got to manage those emotions when it comes to trading. Another pitfall I've seen is that there's just a lack of record keeping. Successful traders keep a detailed trading journal so that they know their rationale for why did I buy this stock? Why did I sell it at this price? What was the outcome of that trade? What lessons did I learn from the trades that I did make? This is invaluable. The trading journal is just invaluable. I have a little black book that I have on my bookshelf, and I keep track of many different things in it. And one of the things that I keep track in it are the outcomes of different trades that I've made over the years. Very, very important. And then, of course, that helps you review your performance and then adjust your strategies based upon that data. Let me leave you with one more pitfall here, and that is underestimating the importance of market research. Many new traders feel as if they just have to find the right ticker. All they want to know is the ticker symbol. They say, what ticker should I buy? That's all they want to know. Well, that's not enough. It's not enough just to know the ticker because it may be wrong, quite frankly. What you need to know is how to stay updated with market trends. You need to understand what economic indicators are and how they impact the market. You want to know how to read a chart and how to use technical indicators. You want to know time frames and how to interpret volume and price analysis. I mean, these are the things that you're going to need to succeed. And so ongoing education and a curiosity that keeps you constantly understanding or constantly seeking out new information and researching, it's just going to help you make better informed decisions, and it's going to help you better understand the market. So in conclusion, avoid these common mistakes by preparing thoroughly. Stay disciplined. Continually educate yourself. Remember, trading is not just about making money. It's about making smart, calculated decisions that lead to consistent profitability over time.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
All right, friends, welcome back to the final moments of today's broadcast. We're wrapping up today's episode entitled Stock Trading Basics. I sure hope you enjoyed this broadcast. We really had a good time going through these 7 frequently asked questions that are so common for new traders to ask, and I hope that you benefited from the things that we talked about. And as always, I'd like to leave you with a final word. This time, it's a critical piece of wisdom from one of the greatest investors of our time, Warren Buffett, when he said, and I think it's very appropriate for today's broadcast, risk comes from not knowing what you're doing. Now, that quote really encapsulates a fundamental truth for traders, and that is the more you know, the better prepared you are to make informed decisions and manage the risks that inevitably will come to you whenever you're trading. So throughout this episode, we've covered many essential questions that every new trader faces, from understanding the difference between stocks and ETFs to strategies for picking stocks and minimizing risks. Now remember, the key to successful trading is not found in chasing the next big tip or some shortcut, but instead it's built upon a foundation of knowledge and research and discipline and strategy, So I encourage you to continue your education in the markets, whether it's through books or courses here at followthemoney.com, or, just keep building your understanding, keep refining your trading approach. And as always, make sure that with each trade that you make, that it's based not on hearsay or not on impulsive decisions, but instead upon solid research and a clear understanding of your own personal financial goals and risk tolerance. So once again, thanks for joining me on today's episode of the Follow the Money podcast. I hope this episode has provided you with valuable insights to start or improve your trading journey. Remember, in trading, as in all aspects of life, knowledge is not just power, it's profit. So keep learning, keep questioning, and most importantly, keep moving forward with confidence. And if you need any help as you get started as a new trader, feel free to reach out to us here at followthemoney.com. That's why we're here. We're here to help. Until next time, my friends, remember, when you want the truth, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Until then, God bless.
Contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of ftmdaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial